Well, hello everybody and welcome to Cybos Spotlight, and under the spotlight today is financial inclusion. Why do we care? Why should we care? Do we care? How many people care? That's what we're going to be discussing with a very special guest in just a moment or two. Let me tell you a bit about him. He's director of the Financial Sector Program at Harvard Kennedy School's Center for Business and Government. He's a lecturer in public policy. He has 35 years under his belt of experience, of international experience, designing, implementing and evaluating development policies. He's worked for private clients, he's worked for governments. He's an expert on the development of bank and non-bank financial institutions. And of course, he's talking on a very important subject that we've heard a lot about this week, as I said, financial inclusion. Please give a warm welcome to Jay Rosengard.
Good afternoon. It's a pleasure to be here, and I think the timing is wonderful when we think about financial inclusion. I understand we just concluded a wonderful panel discussion, and then you all know the keynote speaker in a few hours from now, Bill Gates, will also be talking about financial inclusion. So I was asked to just say a few words about what exactly is this, what's the big fuss, and why should we care? So that's going to be pretty much the extent of my comments. And financial inclusion, quite simply, is trying to ensure access to formal financial services for everybody. So not just those at the top of a nation's economic pyramid, but also those who are most often excluded, and that would be low-income households and family businesses. And in many countries, that's most people and most economic activity. And there's also a significant subset of underbanked or unbanked customers in high-income countries, often in urban environments and immigrant communities. When we talk specifically about financial inclusion and what it might be, it involves a series of financial services or a package of financial services that I'm going to list in order of demand. So the service most in demand among low-income households and family businesses is payment services. It's not credit, it's not microcredit, it's payment services, and we're talking about transfers and remittances. So if you're trying to move money, for example, from rural areas to the city, maybe your children are going to school in the city and you're trying to send tuition money, then hopefully later they graduate, they get a good job, and then they send money back to the village. So just moving money around the country from rural to urban, urban to rural. And then we talk about payment services, payment of utilities and other regular routine expenses, and then remittances. So a lot of countries send workers abroad, and the key is how do they get money from where they're working, not just back to their country, but to their village or hometown. So, for example, from the Middle East back to a town in Mindanao in the southern Philippines. How do you manage to do that in a cost-effective way without actually giving the money to somebody to carry back for you? The second most demanded service is saving services. And this would be saving for a rainy day like we all like to do, perhaps saving for an investment, a business opportunity, saving for your retirement. Many countries, there's not a very inclusive pension program or healthcare program, so your retirement is essentially your kids and any savings that you would be able to accumulate. Also, a lot of small businesses are engaged in very cyclical activities, seasonal activities. So sometimes you would like to save simply for income smoothing between, for example, the time of the harvest, when you have a lot of money, till the time much later when you're waiting for the harvest and you don't have any cash available. The third service most in demand would be microcredit, credit services. And this, again, can be for small family businesses, and mainly for working capital or very small investments. In a small business, it's very difficult to distinguish between a small investment, like an extra sewing machine that generates income immediately, and normal working capital loans. Could also be for a household, for consumption, or for some large investment. And around the world, the two largest investments that households borrow for are shelter, your home, your family home, and the education of your children. And also perhaps some large, what we call consumer durables. A fourth service that's in growing demand are more innovative risk mitigation tools like health insurance, life insurance, and crop insurance. And the crop insurance, you've seen an awful lot of innovation in something called weather indexed crop insurance, so that rather than try to figure out how much somebody lost going out to the farm, measuring everything, and all of the fraud that that encourages, is to index the results of your farming to some neutral, easily verifiable indicator like rainfall. So weather indexed crop insurance. And here I suppose I should also mention an even more rapidly developing area people call digital financial inclusion, and that is trying to take advantage of mobile phone technology to get access to these formal financial services. And the reason is that there are many more people who own phones around the world these days that have bank accounts. And so if there's a way to kind of skip that step and get at least payment services through your mobile phone, you're including a lot more people in your formal financial sector. But I'm going to be a little bit of a naysayer here to remind everybody that using your phone for payment services is really a means to an end. People are sometimes fascinated by the technology, and the innovation is technology driven, but not really thinking about how does that actually benefit the customer in the long run. And the idea of using your phone for payment transactions lowers transaction costs, which does contribute indirectly to disposable income, but in the end, we want to have access to financial services to increase income, accumulate assets, and improve people's standard of living. So again, trying to think about how to be smart in utilizing new technology. So when we talk about this bundle of services, it's really not that different from what we all want. Payment services, saving services, credit, insurance, use of the latest technology to make it more convenient, more accessible. So the real innovation in financial inclusion is trying to adapt these services to the conditions, the preferences, the context of lower income markets. And so what we're talking about is coming up with innovative product design, appropriate pricing, and delivery systems to try to serve these markets in a way that's financially sustainable. So you're also talking about institutional innovation to reach these markets. And financial sustainability is important because if you depend on a lot of external support, grants, government money, donor money, that's going to run out. Donors get bored, flavors change, and then you have a system that's really not sustainable. And so what we see in the innovation of financial services for these demographics is a lot of what I would call social entrepreneurship in the microfinance and SME financial sector. That is, how can you do well and do good at the same time? Make money, help people, not as a kind of gravy or extra benefit, but have it as the core of your business model. That if you serve these demographics successfully, you're going to have significant social impact, and that's the key to generating profits. So when we talk about some of the innovation in adapting conventional products to non-conventional markets, you think about the product design. And so what you often want to do with, for example, microcredit is to try to match the repayment schedule to the cash flow of your customers. Sounds pretty simple, but it's often overlooked. So if you're lending to a trader, a petty trader, you can have maybe weekly or monthly repayments. If you're lending to, say, a farmer, you might want to have some type of seasonal loan, but not have it all due at the harvest. The problem with having it all due at the harvest is that's when prices are the lowest. So maybe have 3 payments or something spread out so that when there's not such a glut of product on the market, the farmer gets a better price and makes more money with the loan. Or say you're a brackish water shrimp farmer. So the cycle there might be every 3 or 4 months. There again, you want to kind of tailor both disbursement and repayment along the cash flow capabilities of the borrower. When you look at pricing, one of the things that's controversial is a relatively high interest rate, for example, for microloans. But again, what you're trying to do is to bring the product closer to the customer. It's going to increase your transaction costs, your delivery costs, but it reduces the transaction costs of the borrower. Rather than having to go to the big city to get the loan, use a half a day or a whole day, pay the transportation, miss the business opportunities, you're trying to bring the product to them. So this is, again, innovation in both pricing to pay for it. It's actually going to be higher than conventional loans, but that's not unusual. Bankers know best rates usually go to the corporate customers. Large businesses get the next best rate. Small and medium-sized enterprises get the worst rates. You're going to have even higher loan costs for the microloans because the transaction costs per dollar lent are going to be higher. So again, you're trying to find a way to do this in a sustainable manner. And sustainability is also important on the savings side. Do you want to put your money in a bank that might not be there tomorrow? Unlikely. It's important for credit repayment. The main incentive to repay for microcredit is the same as any other credit, it's future access to credit. So if you think that I'm going to repay and they're going to fold tomorrow, then it's not going to be available, the smart thing to do is don't repay. So again, the idea of financial sustainability, it builds trust and it creates the positive incentives to develop a lasting long-term relationship between the customer and the financial institution. Other types of institutional innovations in trying to deliver these services to take advantage of the strength of formal banks and the strengths of community-based organizations or development organizations and kind of a service provider contract model. So you might take, for example, from Haiti, the largest commercial bank, Sojabank, created a community-based nonprofit called Sojasol. And the idea is that Sojasol doesn't know anything about how to manage all of the back office operations, treasury operations, IT, personnel, all the legal stuff, but they're really, really good at understanding the community, identifying good customers, and providing good service to the customers. So again, you're trying to take advantage of being embedded in the community. And in the end, when we talk about financial services for low-income markets, it's really just good community banking. I don't know if any of you have seen the film. It's very famous in America. It's called It's a Wonderful Life, Jimmy Stewart. They show it every Christmas. And it's about this banker who's about to commit suicide until people point out all of the good he's done in the community and all the people he's helped by understanding people's needs and providing them in a timely and sustainable fashion. So when we've seen innovations in product design, pricing, delivery systems, and institutional models, it is really the tool to try to extend formal financial services to a much wider market. So that's really what financial inclusion is, and some of the reasons that it's exciting, where you see a lot of the innovation. Why should we care? That was the second part of the question that I was supposed to address. And quite simply, we're trying to provide those with the greatest potential to benefit from economic growth with the financial tools they need to realize these benefits. That's all we're trying to do. And we're trying to address the paradox we see around the world where you have rapid economic growth with rapidly growing inequality at the same time. So nations are getting richer, but the income gap and the wealth gap is growing within the nations. And that really starts with inequality of opportunity. And if people have access to the tools they need to take advantage of these economic opportunities in rapidly growing economies, then you've created a much more sustainable model politically and socially for development in the future. So this is why we should care, and because it is so important to the type of development model you want in your country, I don't think that financial inclusion should be an add-on. It shouldn't be an extra thing you do on the side. It should really be mainstreamed as a central part of your development strategy. So when you look at financial sector development as one of the tools you need for overall economic development, you want to make sure that the financial sector is inclusive of all segments of society. So I believe I've addressed the two main questions. What is financial inclusion? Why is it exciting? And why we should care about it? And I had told the sponsors that I'm not going to talk any more than that. If anybody has any questions or comments from the floor, feel free. And if you are shy and don't wish to speak, that's all good. Thank you very much. Oh, we have a question. Yes, sir. The incentive for banks, money. Seriously, a bank, you're talking about commercial banks, for-profit banks. You have a responsibility to your shareholders to earn a good return, and you have a responsibility to your depositors to protect the deposits. So the incentive should be to improve your bottom line. So not philanthropy, not corporate social responsibility, not good politics and press, although that's fine. It should be a new business center, a new profit center. So let me give you an example from probably the largest and probably least known micro banking program in the world. It's from Indonesia. It's from a bank called BRI, Bank Rakyat Indonesia. Full service commercial bank. International offices, corporate finance, SME finance, retail banking, everything that you would look for in a bank. It used to be a state bank. It had an IPO. About 40% of it was sold to the public. And the most profitable business center in this bank is the microbanking unit. And it often cross-subsidizes other parts of the bank. So that being said, I should warn you that most commercial banks that try to do this make a mess of it, and they fail. Because they think that, for example, microloans are just small, big loans. So if I do exactly what I do for big loans, but just make smaller loans, they will lose money. They don't know how to assess the credit risk, and they don't know how to price the instrument. They don't know how to deliver the product. So most commercial banks, if you're getting in it not for profits, don't do it. If you're getting in it to make money, you're going to make the right decisions in how you design the product, how you price the product, and how you deliver the product. And there are some examples around the world of commercial banks often setting up a subsidiary because you're going to hire a different profile of person. You're dealing with very different markets. So it's often either in BRI, it's a special strategic business unit. Could be a wholly owned subsidiary, or it could be some kind of even a partnership like the example from Haiti. But I feel pretty strongly that if a commercial bank is going to do this, do it to make money. That's why I said doing well and doing good at the same time. Excellent question. Yes, ma'am.
Isn't there an element of education that goes along with this as well, to educate people who have not had access to the financial services about the responsibilities that go along with that as well? And I haven't, could you comment on that?
Again, excellent question. And there are two parts of it, and you touched on both. One is general financial literacy. So understanding how these tools might help you, how these tools might be of benefit to you, but the other part that you implied is also consumer protection. Knowing the true cost of borrowing, knowing the responsibilities, knowing the commitments that you're making. So there are a lot of efforts around the world in financial literacy, less so on consumer protection. And I think that's a missing element in a lot of this because, and we saw it in the US, part of the reason that the financial sector collapsed in the US was subprime mortgages, and they were targeting basically the same demographics of lower income communities, not really understanding the products they were getting into, not understanding the costs, and not understanding the commitments. So absolutely important. And there's a third there's a third part of it that you didn't mention that I'll say is that sometimes bankers really underestimate how smart these customers or potential customers are, and they try to educate them on things that they really shouldn't. They certainly know the value of money. They know the value of losses and profits. If you ask them for a set of accounts from their business, they won't have it. If you force them to make it, they'll make it up. But they do know if they're making money, and they do know generally how. So again, this is when you're trying to do your credit analysis, and it's kind of a bridge between the two questions. The risks are exactly the same as big loans, the credit risk. It's willingness and capacity to repay. But for the small businesses, how do you assess the credit risk? How do you assess character when there's no credit report, there's no scoring system? How do you assess capacity to repay when there are no financial accounts or standard financial accounts? So again, the innovation is often a really simple, reconstructed cash flow statement. Because they can tell you in their own terms, either weekly or daily or seasonally, how much is coming in, how much is going out. So financial literacy and consumer protection are very important, but don't underestimate the knowledge and wisdom and character of this potential market. Well, thank you very much for your patience and for contributing to our dialogue. I understand this is going to be posted in the not too distant future on YouTube, so available to all. So for your friends and colleagues who couldn't make it here, tell them to check it out on YouTube. Thank you very much.